So over to the next session. First of all, a good round of applause for everyone. Thank you. So now we are having a very interesting session, brief but impactful. It is powered by SAP, and we are having the speaker as Mr. Sebastian Gibier. He is head of global expansion, grow with SAP for scale-ups. And as he would join us on the stage, we would have a small video to be played. So requesting everyone's attention for the next session. Shaila, could you get the next speaker, please? Okay. So the video. Hello. Let me just check. In the meantime, you can start.
Yeah, we can start. Hello, everyone. So, good afternoon. I'm Sébastien Gibier. I'm the global head of the global expansion of an SAP program called Grow with SAP for Scale-Ups. And I'm really honored to be there because I'm coming from Paris. And thank you for welcoming me here in India, my first time in India. Today, what I want to propose to you is to discuss about how to grow in good condition by taming the complexity. And the first thing that we have to ask ourselves is, when do the growth stage start? And the growth stage starts really at the Series B for me, because before the Series B, everybody, the founders, his team or a team, are really focused on structure about the product, about building the product, building the first customer base, and everybody is done about that. So nobody think about structuring the processes, but that's normal. That's normal to be really focused on the product, on the customer before Series B. But when you arrive at the Series B level, the importance really changes. The priority of the founders may shift to become the priority one on structuring the business. And what does it mean to structure the business? It means to structure your finance, to structure your HR, to structure your procurement. Otherwise, if you don't structure yourself starting at Series B, I'm not sure you're going to succeed. And let's be honest, these topics are not the funnest one, but need to be tackled in a way, okay? So if you want to succeed starting at Series B, really you need to focus on the structuring your process. But when you ask yourself, okay, I have to structure my processes, what is the value behind that? Okay, what I get if I structure my business? There is three things where you're going to get value from. The first thing is that by structuring your processes, you will have really, you will improve your operational excellence. What does it mean, operational excellence? Operational excellence is that you're going to improve your top line. Okay, because if you improve your processes, that you're going to be able to focus more on your business, and you're going to improve your top line very easily. The second thing is that putting in place some processes, especially on the finance side, on the HR side, you're going to improve your bottom line. So that's the second aspect where you're going to get benefits, improving your processes and putting in place operational excellence. The second value that you will get by structuring your processes is to get a better valuation, okay? And it seems a bit less obvious, but indeed, your investors will pay more attention to you if you structure your processes, especially around a standard of the market, okay? And doing that, you will have a lot of more valuation instead of having a spaghetti IT. What I call a spaghetti IT is that you don't base your IT, you don't base your processes on standard. And the third value you will get from structuring your processes is really that to be ready, much more ready for exit or your next fund raising. How is it possible? If you want to, in fact, I look to the founders I'm working with, all the time what they have in mind is, okay, how I will be ready for my next funding, how I will be ready to be acquired, or how I will be ready faster to acquire a new company. And for that, in fact, the question is simple. You need to be ready in hours if you want to catch the opportunities. And to be ready in hours, this is possible only if you rely your processes on the standard. And the second thing is that if it's not enough to be ready in hours, you need to be ready relying on the standard, relying on the compliance. You need to be compliant. Otherwise, you will not get through the due diligence. So that's the three main value you will get from putting some structure up to the Series B, is that operational excellence, get a better valuation, and be ready for exit and next fundraising. But you will ask me, okay, but how can I achieve that? Okay. I'm part of SAP, and SAP is the leading company running, helping and supporting more than 4,000 companies in the world, running their business and being the leader of the world today. But you will ask me, okay, that's fine. That's fine that you're supporting the big company, but how does it fit to the scale-ups, okay? Because let's be honest, when I talk to founders, each time what they say, and when they look at the SAP, they're saying, okay, yeah, but it's for big corporates, it's expensive, it's so long to implement, which is not true, okay? So let me explain what we are doing. In fact, we found Grow with SAP for Scale-Ups, which is a really dedicated program for scale-ups for Series B up to the IPO. This is a dedicated program to support you during your growth journey. And what do we bring? So what we bring is that we have listened to you. And when you're saying that SAP is expensive, we have built specific commercial terms for you, especially, for example, the 6-month free. Then what you say to us that SAP is too complex. So what we've done is that we have taken the 50 years of best practices, standardized best practices in the world, and what we have done is that we tied that to fit your size, to fit your growth journey. And we have done that, it leads to project implementation, to package implementation that fit in weeks. For example, if you want to put the first standard financial ERP, this is only 4 weeks. So we are not talking about months, years. We are talking about 4 weeks to get your foundation of your finance running on the best in the world, meaning SAP. We've done that also for HR. What we've done is that you could have your foundation of HR in 5-6 weeks with SAP SuccessFactors. So this is really important, and what we've done then is that what we have in mind is that this is not enough to run on SAP. This is why we have created a set of other services that are on demand that help you to, for example, become a partner of SAP. What does it mean to become a business partner of SAP is that, for example, I was discussing with the founders this morning who want to extend to Europe. Okay, let's do some intro. We can do some intro to our customer market in Europe. We can help you also to become a business partner. for example, create integration, especially if you're a SaaS company. We can help you also in your communication journey to put you on the stage during our big events. So this is a lot of things like that that we can do in the Grow with SAP for scale-ups. And the good thing is that you will not be alone. We have already 500 customers running on SAP with the same stage as yours, hyper-growth companies. And we got a lot here in India, like Lucius, Upgrade, Ola, and all those companies are running on SAP, and we are supporting them in their growth journey. So I hope you understand and that you have maybe a question on that. Don't hesitate to come and visit us on the Grow with SAP for Scale-Ups booth. And in the meantime, thank you very much for having me on stage. Thank you very much.
Thank you so much, Sebastian. It was nice hearing you. Any particular questions from the audience for him? There's a question.
I just have one question. I just want to know whether... Hello, am I audible now?
Yeah.
I just want to know whether SAP works with e-commerce businesses, especially startups, e-commerce startups. In what capacity do you work with e-commerce businesses, and what is the volume of e-commerce businesses you work with?
So there is different things there. There is, of course, a foundation for any company, for e-commerce companies, but like all the retail company, SAP has really good software for that, to support your finance, for example, to support your HR. But then there is other opportunity that you could seize in SAP. There is specific solutions dedicated to the e-commerce and to the retailers, especially all the things regarding the customer experience stuff. And also one good thing that you could leverage is the Ariba network. This is a network of suppliers that you could really engage with, that could fed content and product to your supply chain. So this is where you could also go there. The other things is more on the hypergrowth hub services that we provide alongside Grow with SAP for Scale-Ups, is that, for example, if you start becoming a business partner at SAP, we could introduce you to the big brands that are already running on SAP. We got good customer clubs that really wish to discuss with new company like yours, innovative company, and we could do the go between your company and those one.
Thank you.
Thanks for the great overview. I just wanted to understand, one, is this solution cloud-based, or it would be on-prem, or you have both the options? And second is, what is the cost like? So now it's for scale-up, so SAP is considered to be expensive. So what is the cost for this particular version?
So for the first question, we are product agnostic in the portfolio of SAP. So if you think the on-premise solution fits better to your company, it's fine, but we are fully driven by cloud. So it means that all what I said before regarding finance, regarding HR, regarding procurement, etc., it's all about cloud solution. And in fact, this segment, the scale-up segment, the hyper-growth company segment, are looking for standard and cloud. So we're running on the solution. Regarding the price, I invite you to come to discuss about that, but what is interesting is that we're comparing to the other solution in the market, we are really competitive and even lower than the others. And I think this is what I wanted to share today, and I would be glad if you could bring that home tonight, is that, in fact, I think what we are missing at the moment is more a question of perception regarding SAP. We got a lot to bring to your kind of company, the hypergrowth company, in terms of processes, standard, etc. But we are not well known in this segment. We are known for the big corporates, even if we have solutions that fits to this segment. So thank you very much. Thank you very much.
Thank you so much, Sebastian. And a token of appreciation from. Okay. Thank you, SAP. And thank you, TiEcon. And we are now inviting Mr. Rajneesh Kapoor. This session is powered by Indian Angel Network, and this is on Angel Investing Masterclass from Rajneesh Kapoor, Managing Partner and Fund. Welcome, Rajneesh. So over to you.
Thanks. Where's the clicker? Yeah, here's it. Just do this. Hi. Okay. No, it's okay. I'm going to use it from here. Good afternoon, everyone. I hope we get some more folks interested in angel investing. We have a thin crowd here, but so let me just do one thing before I start. How many of you are already angel investing? How many of you are doing this already? None. How many of you want to do this? Okay, at least we have a few good hands, and I hope to inspire at least one of you, if not more. Okay, so what I'll do is I will, just indulge me in the first few slides about where India is, right? And just to set a context, just to collect our thoughts. So I don't know how many of you remember the year 1991. Many of you in the audience would have been born after that, but some of us perhaps before that. 1991, India pledged its entire gold reserve. What a moment in history that was for us. A sad moment. And fast forward, we are in 2024, and look where we are from that year 1991. 30 years of post-liberalization. I'm just comparing again with, sorry, can I have a microphone, please? I can just hold this. Yeah. It's okay, I think it's okay. I'm going to refer to this side. So in 1991, our GDP and current prices was $275 billion. We are 3.4 trillion today, and we're already talking about $5 trillion economy, right? Our foreign currency reserves were 5.8 billion, and today we are at about 601, perhaps $650 billion, what I'm told. Exports were abysmal 18 billion, and we are at 763 billion. And imports are 916, and earlier it was 24. As an economy, we overtook UK in 2022, and we are one of the fastest growing economies in the world today. And if you look at the CPI, which is about less than 6%, and we are a very young population. There are reasons I'm bringing some of this so that you just collect our thoughts into what I will dive next. And really what's happening is that there is today, from a startup ecosystem, there's an extreme level of government support. I think the government, since 2014, and has catapulted the startup ecosystem. The founders of today are living in some great times, at least at the seed stage. Anywhere from 25 lakhs to 5 crores is being doled out across different schemes. And you just heard, I don't know how many of you were in Make in Maheshwari's session, where Delhi government is actually giving out 2,000 rupees to start. I mean, it was absolutely an exhilarating moment, at least session that we had. Young school kids straight out of 12th, becoming entrepreneurs. And hopefully some of them will actually raise funds and become, large businesses and large unicorns. Traditional sectors, with that were holy cow, I would say defense and space, have all been opened up. IN has several portfolio companies which are actually working in the defense sector and the space sector. So two of our companies, Dhruva Space and Manastu Space, are actually now building out solutions for the space tech industry. These opportunities are not there earlier. I know that, and there are some wonderful programs by the government called the IDEX, where contracts are guaranteed. Once you cross the milestones, which are paid milestones, contracts are actually guaranteed. We have a very stable interest rate regime. And obviously, there's a whole China plus one tailwinds which are helping India. The IT services industry grew from 50 million 3 decades ago to about 250 billion last year. And beyond the contribution to the economy, what it has done is actually created a large engineering pool fueled by a large ecosystem of engineering colleges, right? We have stable public markets and the largest two-wheeler production in the world at 4.25 million units. So, as the previous slide said, the stars have aligned for India, right? If you look at the other matrices here, right? 700 million internet users, 425 million estimated rural internet users, 1.3 billion plus internet users by 2030 is what the prediction is, and we have over 100 billion UPI transactions per year. Digital volume, payments volume is of 4.12. In 21, it has exceeded 10.8 billion in 23. India has more real-time payments transactions than China plus UK plus US combined. And India has the highest number of YouTube, WhatsApp, Facebook, Instagram, back on the cheapest data rates that you can think of in the world. Besides the digital infrastructure, if you look at it, there is a physical infrastructure. India now has the second largest road network in the world, and other related infrastructure is actually attracting a lot of FDI. So India today is built on a great digital infrastructure and physical infrastructure. And basically, we are setting the stage for the $5 trillion economy. What does it really mean? It really means a lot for the startup revolution. Because on the back of this digital and physical infrastructure, we're actually building out a next generation of problem solvers. If you look at the startup ecosystems, three large spaces, India, US, and China, we are at number 3, but the fastest growing amongst the 3 giants here. Unicorns, if you look at in for the second time in the row, India had produced 23 unicorns, outpacing China. Now, for each unicorn that India produces, please remember that there is a whole lot of ancillary startup ecosystem that develops. Think of Flipkart. Flipkart is just not, selling you books or sending you, mobile phones. There is logistics. There is technology around logistics. There is whole mapping solutions. There is AI companies which are actually helping the marketplaces on Flipkart to better their demands. So there's a whole lot of startup ecosystem being created by these unicorns. So unicorns are begetting another set of unicorns. I think that flywheel is what we are seeing today. If you look at the number of VC deals, they've jumped from 157% from 2022. So sorry, these are little dated figures, but just to set the context in the macro terms, we've seen a huge jump in VC deals and also FDI in the PE VC investment space. We've also seen a large number of AIFs. I heard Mr. Ramanan yesterday from SIDBI that there are 1,000 AIFs today. What does it really mean? That when startups are raising their rounds from their friends, family, and the initial rounds, angels is which is the next round, which really helps to bridge the capital gap between the friends, family, and the next set of investors, right? Those next set of investors are already flush with capital to be able to, fund these companies. The third phenomena, and which is pretty apt here because the theme of the conference is the New Bharat. The New Bharat is being built from tier 2 and tier 3 towns, right? If you look at Jaipur, if you look at Kochi, Indore, Chandigarh, all of these towns are actually now a thriving ecosystem. In fact, India probably has produced some of the best unicorns out of the tier 2, tier 3 towns. I mean, if you look at Wooden Street, which is a portfolio company out of Jaipur, we have Razorpay, we have Dehat, which is coming from Bihar. These are all unicorns that are coming from tier 2, tier 3 towns. Largely back on again, what I mentioned earlier in my slides, infrastructure, broadband connectivity, and better air and rail linkages. The bigger thing that is also happening is, and you heard that the Makin's band of entrepreneurs, young entrepreneurs, is that the taboo around entrepreneurship has actually gone away. Entrepreneurship is now an aspirational thing, very much accepted and being encouraged. We are seeing this across not just metros, but tier 2, tier 3 towns. You know, young people want to build businesses today. The tier 2 towns and 3 towns are also contribute to 40%, if not more, of the talent that is available to India. These people understand the problems that the India is facing. So all in all, I wanted to set the stage as to what is the potential here, right? We are the third largest ecosystem in startups. We are shifting from a services nation to a product nation. We've seen global products come out of India. And again, that is creating another pool of, talent which understand how product development in a global setting happens. Some of these companies like Zoho and others are also now creating the next level of entrepreneurs who can now know how to build a product, how to sell a product on the global stage. And of course, we have the UPI, we have all the India stack, all the rails are there to actually enable that. We have a large population of 370 million, so there's a huge consumer play that is happening here. So, with all of this consumption story, how do you participate in this? How do you participate in India's growth story? And one of the best ways, beyond public markets, and is actually investing in startups, right? There's a new class of investment, asset class of investment, which is really the angel investing, and you have, you also have similar class, which is the if you have more wealth, you can actually put it into AIFs, VC AIFs, okay? And I would recommend that, if you have surplus wealth, beyond, of course, doing it into traditional FDs and mutual funds, if you have surplus wealth, please think about this asset class. It's also one of the best performing asset classes. So if you look at equity, and my wealth manager, and if somebody has a disagreement on it, tell me, Rajesh, if you do 13, 14%, that's what you should target, not more than that. That's what public markets will give you, typically, right? If you are hyper smart and get lucky, you may actually get 18%, but typically it's about 13, 14% range. Real estate about 5%, debt 6%, and gold 4%. One of the asset classes which is potentially performing, over, this is a data for 10-year period for us, it's about 25% of IRR. A bit about IN. We were founded in 2006. In fact, we pioneered the concept of angel investing, institutional angel investing. Prior to that, HNIs and startups had a difficult time to get together. And it wasn't just a scalable model. These were individual connections that were happening, but there was no platform that was available. The other negative side of this was that because the startups were actually now tapping one or two HNIs, the HNIs were having to write bigger checks, 50 lakhs, a crore, right? Which is actually not a good thing in a way. Humbled to be recognized by Forbes India as one of the iconic moments in India's 75-year history. Like I said, we pioneered the concept. Again, a quick introduction before I get into why in angel investing. IN comprises of 500 plus angel investors. These are the who's who of the entrepreneurs and CXOs of India and 9 other countries. We get about 7,000 deals in a year, which then goes through a multi-tiered screening process. Beyond the capital, one of the things that we very deeply believe and provide is the mentorship and market access for our portfolio companies. And it has become really the epicenter of we bring in the incubators, the VCs, the corporate family offices to start investing in startups, right? We've given some exceptional returns, 400x, 3 unicorns and 5 unicorns, and we have a low failure rate of about 30%, sub 30%. Our investments have catalyzed follow-on funding to the tune of $3 billion, and the market valuation of our portfolio companies is about $9 billion. Some of the iconic names: Boxit, Dhruva Space, like I said, Loginex in logistics, Farai. Uniform has flipped to the US. It's a $2.5 billion last. In 2021, they were valued at $2.5 billion. Wooden Street is a new icon. So some of the unicorns here. Many of them actually are coming from the tier 2 towns here, right? I mean, Pool is here, which is from Kanpur. We have Wooden Street from Jaipur, like I said. Yeah. So what is angel investing, right? I want to set the stage of what India is, collect our minds. So say, look, this is the opportunity, right? This is the opportunity that you're looking at, and how do you participate in it? So it's an emerging asset class for HNIs. It actually provides the alpha, like I said, 25% roughly IRR. You can think of it if you do this correctly. You can even better it if you do this, if you pick your bets. And typically it's the first investment in a venture after the friends family round, right? So the first round that the startups typically raises from friends and family, and this is the institutional round that startups raise. The typical raises by the company. Don't mistake this. This is not an investment expected from an angel. This is an investment that is raised by the startup. Is between 50 lakhs to 6 crores. These are early stage, often pre-profit, certainly pre-profit, often pre-revenue, and valued on potential, future potential. Basically on the quality of idea and the problem and the innovation and what the quality of the founders really is. Beyond the capital, as an angel and the right, I mean, that's the reason why we have the word angel is you don't just write your check. You write your check on time. You also write check on your expertise. Because you've been there, you've done that, you've run your businesses, you've been a part of a senior leadership in a company, so you kind of understand how businesses are built. And with that expertise and experience, you are able to kind of help them scale. So as an angel, you'll be expected to engage with some of the brightest minds that are building these businesses, fellow angels, and your own mind to basically get this all together. What does it mean? It means you're going to create value beyond valuation. That means, as an angel, you will yourself transform. I've been an angel investor for 10 years, and I've seen my own transformation. Because it's almost saying, when you teach somebody, you become better at it. It's a hard one, right? When you teach somebody, you get better at it. You also create disproportional returns. I have to say this, there's no denying this is high risk, but for that risk, you take high rewards. I mean, that is the law of the universe, right? I mean, without risk, you don't get returns. And small ventures can actually become, global footprints and can become an alumni, company of yours, and you can be really proud of what you built out or helped build out. So who are angels? These are typically, like I said, successful entrepreneurs, CXOs, business owners, family offices. People have been there and done that, right? And you kind of mentor the founders, provide operational inputs, you provide strategic advice, and also open doors for them to with connects, customers, and validate their. You also need to understand, like I said, your risk return paradigm. I mean, if you lose money in a startup, you don't go and say, hey, get my money back. That doesn't happen, right? I mean, you don't do that. That's part of the game. You invest you build a portfolio, and you basically, there's a whole thing called power law. Out of the 10 investments that you typically make, 4 or 5 will be written off. You have to believe that this is what's going to happen. This is how it happened. Out of the remaining 5, 3 will give you about moderate returns. It is the last 2 which will probably give you a kicker, which will not only wipe out your losses from the previous one, but actually give you a substantial alpha to cover all that. And it is a critical bridge between the friends, family, and fools round, like I said, and the VC funding. So you come sort of in between there. Now, I'm going to talk a little bit about angel investor groups, right? I mean, you could invest yourselves as individuals. As an angel investor myself, I would not recommend that. I mean, I think what happens when you do it yourself is that you don't benefit from the collective minds of seasoned investors, because in a pitch room or otherwise, there'll be differing thoughts about evaluation of a startup, and you kind of learn from each other. So I would recommend that you join a group and start to invest as a group, right? And that way you allow you write smaller checks, but you write across a number of companies. My recommendation would be that you should carve out capital for first year, second year, third year. That's what you do. And you basically invest in 10 to 15 startups in a year. Depending on the group that you join, it could be anywhere an investment of 3 lakhs to 5 lakhs. If you're generous, you can actually put more if you believe in that company, and you put into a number of companies, right? Sorry. It's not going. And like I said, you take advantage of the collective wisdom. And what happens is when you're investing as a group, then the startup also has the advantage of access to a larger group of mentors and their network to help them scale. And that's what they need at that stage the most. And the decision to invest in a startup is always, always yours, right? Unlike when you invest in an AIF or even for that matter, mutual fund on the public market side, you're not taking the decision. It's the fund manager that is taking the decision. But as an angel investor, you take the decision. You believe in this company, you believe in their thesis, you kind of connect, you invest. You don't connect, you don't invest. There are different kind of schools of thought. I would not recommend a FOMO. I mean, understand the thesis, build your thesis around a startup and then invest in that. And we have one of the best angel investors crossing the stage. So how to go about it, right? And like I said, when you join a group, I'll do that in 5 minutes, okay, thanks. So when you invest through a group, you get access to a high quality deal flow, and you get access to domain experts within the group. And there are different kinds of, I would say, instruments available, debt, investors, and also their networks. You also get access to high quality execution team because you will not be able to do a lot of things yourself. You depend on the group's secretariat to be able to help you do that. And then of course the diligence by the team, by the angel group and the secretariat like IN for that matter. They'll also help you understand the valuation, what valuation you should, what valuation should work for a particular stage of the company, the sector that is operating in, and the stage at which the company is. And of course, the angel group, the right angel group will help you with the documentation. They will take the onus of doing the documentation. And of course, lastly, because of the experience, in this industry, the team will actually also help assess the founders for you. So I'll just quickly do this because I know Sanjeev is waiting. So essentially, angel investing is about managing risks. Managing risks about markets, about product, about scalability or execution, about the team, and then of course your decision to invest. I mean, in the markets, is it addressing a large market or a growing market? Is it a need to have or a must to have? Because if you have a must to have solution, it'll probably have a natural traction and it'll have natural, it'll have a less chance of failure. And it's also important to understand what competition is all about. Is there existing competition? Because if there is competition, one must respect that competition, see what they're doing and what the startup is doing differently. And if there are any barriers to entry. Product readiness, is the innovation unique? Is it doing something, same thing differently or different things, in a similar way, right? Is it a wild idea or there is a validation for this? And is there an IP? And there was a session on IP before me. Is the IP relevant IP or not? Because a lot of founders will put IP, and granted and all, but is the IP relevant for the business and the moat? And then we're talking about, different pricing models, GTM strategies. So some of these are risks that you'll have to understand as an angel investor. And I think when you do this collectively in a group, some of this will start to bubble up and kind of, there will be clarity as we go along. And of course, we're looking at the founding team because at early stage, it is a founding team that will make this success, and a mediocre idea can be executed very well by a great team and build a great company. I will probably skip this in the interest of time. The secretary will actually do all the heavy lifting or due diligence, and the necessity to do this is extremely important. I think this is about high risk and high reward. Please remember this. You're looking at an exit horizon between 3 and 5 years, longer in deep tech. And the two kinds of really at an early stage, angel stage, the two kinds of exits that you're looking at, one is an acquisition and the other is an incoming VC. Typically by that second or third round, angels tend to exit. And it could also be a liquidity between, investors. I think with that, I'll end this. I can take one or two questions if you permit. Otherwise, I'll hand over the stage to someone. Yeah. Any question? Yeah, please. Go ahead.
Great overview. So this 25% return which you were talking about, it's all contingent on, say, investing in 10 companies, 5 didn't work out, and add 2, right? So it depends on the type of company. It could become 10% also. So it can vary from...
No, absolutely right. I think the data that I presented is for IN for 10 years.
Right.
All companies. So that's the data that I can present. I don't have data for anybody else. I have data for myself. It's about 25% for us across 10 years, across all companies, across all investments. Now, if you take your bets correctly, if you don't just do spray and pray, which is one strategy that a lot of people have, if you take your bets, you connect with that startup, you understand the space, you could be doing, 65, 70% IRR. I don't want to promise all that, but you could be doing that. We've seen our investors doing in that range as well, right? But yeah, this is the average.
Okay. And the second question, slightly more light on, one can do angel investing directly, right? So I can identify a team and say, okay, I want to angel invest. So what are the benefits which IAN brings over and above the direct thing? What are the essential things you do over there?
We do the heavy lifting. So as an angel investor, you are getting a curated set of deals, okay? And that's a lot of work. 9,000 deals a year to about 250 deals that we present to you. It's a lot of work. We have to understand what works and what doesn't work, right? So maybe I can take this question, offline with you. And yeah, so thank you so much, guys. Thanks.
Thank you, Rajneesh. I'm sure you would have motivated many people for going for high risk, high reward. Token of appreciation for you, Rajneesh. We can. So we thank our session partner Pioneer and co-partners Kalari Capital for the session we just closed.